chances are you are picking ETFs wrong. I've invested over 600 million euros in ETFs and their cousins, index funds, over my professional career. I've also trained thousands of European ETF investors. Here are 5 critical mistakes that I see beginning investors make all the time. To understand mistake number 1, imagine that you are watching Bob and Anna play chess. They play 3 games in a row, and every time Anna wins. If you had to predict the winner for game 4, who would you choose? Well, Anna, obviously. Chess is a game of skill, and clearly Anna is better. But now imagine that you watched Bob and Anna play a game of coin toss. Again, Anna wins 3 times in a row. Who do you pick for game number 4? Well, it doesn't matter, right? Because there's no skill involved. It is pure luck. Here's the problem. Too many beginning investors pick ETFs as if they're predicting the winner in a chess game, where past results give you some indication of future potential. For example, let's say you are comparing a European stock ETF, like the iShares Core MSCI Europe ETF, with an American ETF, like the iShares Core S&P 500 ETF. Let's look at the historical results. So, for the European ETF, we see that over the past 5 years, you would have gained 68%. For the American ETF, over the past 5 years, you would have gained 102%. The American ETF was much more profitable. Looking at this kind of track record, it's natural for us humans to assume that it will continue. We will assume that the American ETF will keep winning. Maybe because America is simply a better stock market. Maybe you believe that American tech companies are the best in the world, or that the low levels of regulation in America will lead to higher economic growth. But the problem is, exactly because America has been winning for so long, American stock prices have been going up and up and up. Look at this chart of average PE ratios in the American stock market. So the PE ratio reflects how expensive American stocks are relative to how much money American companies are actually making. As you can see, current stock prices in America are very close to historical highs. You only had higher valuations during the dot-com bubble. Stock prices in America are so high because they reflect expectations of huge technological progress and economic growth in the future. Now, by contrast, it is unfortunately true that here in Europe, most people expect lower levels of technological progress and lower levels of economic growth. But when you look at European stock prices, you notice that they are much, much cheaper. It would be enough for European companies to deliver relatively modest profits and growth to give you a good result, because you are making your initial investment at a low price. In other words, you are choosing between a market which seems to have high future potential but has high stock prices, and a market which seems to have lower future potential but it also has lower stock prices. This is why, looking forward, there is no way to guess whether the S&P 500 or the MSCI Europe ETF will be more profitable. In fact, this is a general principle. If you compare 2 ETFs with a more or less similar level of risk, similar diversification, and similar fees, then predicting which will win is much more like a coin toss than a chess game. When investment ads tell you past performance does not predict future results, those are not just empty words. This is a truth backed by decades of market data. There is even some evidence that the investments with the best historical profits are more likely to do badly going forward, exactly because they've been going up and up and up, so they may be overpriced. Now, don't get me wrong. I'm not saying don't invest in America. It could turn out to be a good investment. All I'm saying is avoid this rookie mistake. Don't choose ETFs based on historical performance. Now, to illustrate mistake number 2, let me ask you this. Which is a better car? A Volkswagen Passat or the McLaren F1? It's a ridiculous comparison, right? The F1 is great if you want to win a race, but the Passat is much better for a family trip. That is obvious when looking at cars, but it's less obvious when looking at ETFs. Many beginning investors will ask me questions like, Tom, which ETF should I buy? The iShares Core MSCI World ETF or the Amundi Euro Stocks Banks ETF, which is really profitable right now? Now, putting aside the issue that I can't really give people investment advice, that's kind of a crazy comparison. You are choosing between a broad, diversified ETF, which invests in over 1,000 different stocks covering many different industries and countries, with a narrow ETF that covers 29 stocks in one industry and one region. The thing is, like a race car, a narrow sector or theme ETF can be useful in certain situations. It can perform tremendously when things go right for that sector or industry. But when things go wrong, these kinds of narrow bets can be really expensive. One famous example would be Cathie Wood's ARK Innovation ETF, which invests in high-tech stocks like Tesla. This American ETF, which we can't even buy here in Europe, became super famous in 2020 when it gained 153% in a single year. As a result of these tremendous profits, a huge amount of investor money flowed into the fund. And what happened next? Well, the fund went on to lose 23% in 2021 and 67% in 2022. A lot of the investors who got attracted by these big flashy profits went on to experience massive losses. Unfortunately, research shows that this kind of outcome is quite common for sector and theme investing. For example, Morningstar's 2025 Mind the Gap report compares the result of the average sector ETF with the result of the average investor in these ETFs. And over the previous 10 years, the average sector investor underperformed by 2.1% per year. This is because investors tend to jump into sector ETFs too late, after they have become hot, after stock prices have become expensive, and then they go on to get burned. By contrast, a diversified ETF like an MSCI World fund is more like a Volkswagen Passat. It's never going to have a massive profit like 150% in 1 year because your money is spread among many different industries and companies. But it's also quite unlikely to crash and burn the same way that a sector ETF could. So don't make mistake number 2. Don't compare diversified ETFs with sector or theme ETFs. The first is appropriate for long-term passive investing. The second is for making high-risk speculative bets. To understand mistake number 3, picture this. You go to an ATM and you take out 100 euros. Are you richer before taking out the money or after? Well, if there's no withdrawal fee, your wealth did not change. It doesn't matter whether the money is in the bank or in your hand, right? Well, that's intuitive for ATMs, but it's counterintuitive when it comes to investing. Many investors have a psychological bias, which you could call a preference for income. They love getting dividends from their stocks or ETFs because they feel like this makes them richer. Now, in reality, when a company pays out a dividend, it is taking money that was inside the company, which you partially own, and putting this money into your bank account where you also own it. Your wealth does not change when the dividend gets paid out. What should really matter to investors is your total return, which is a combination of dividends and price growth. But the problem is, our brains don't work that way. You feel like you are getting something special when that dividend comes in. Unfortunately, in most countries, dividend-heavy stocks or dividend-heavy ETFs are not attractive because every time that you get a dividend, you are taxed. This is why more and more major companies don't pay a lot of dividends and instead use their cash for share buybacks. And this is why many European investors prefer to use accumulating ETFs, which don't pay out dividends at all. In most European countries, this helps you save on taxes, although there are some exceptions like Austria, Switzerland, and the UK. Now, to be sure, in certain circumstances, for example, if you are retired and living off passive income, including dividend-heavy investments in your portfolio can make some sense. But for many investors, this would be mistake number 3, chasing high dividend ETFs. For mistake number 4, we need to go back to the 14th century and the French philosopher Jean Buridan. There's a famous thought experiment called Buridan's ass, meaning Buridan's donkey. Imagine a donkey standing exactly in the middle between 2 identical bales of hay. This donkey is super hungry. He really wants to eat, but he's exactly in the middle. And the bales of hay are exactly identical. And because there is nothing that is asymmetrical, nothing that is more attractive on one side than the other, it is impossible for the donkey to decide. He just stands there in the middle and starves. Now, you might say that's ridiculous, just pick one bale of hay at random. But a version of Buridan's donkey actually costs investors money all the time. For example, people will spend hours comparing the iShares Core S&P 500 UCITS ETF with the Spider S&P 500 UCITS ETF and the Vanguard S&P 500 UCITS ETF. And they simply can't decide. So they delay investing for weeks or even months. And it drives me crazy. Because look, if you're comparing multiple investment choices where you've researched them all and you know that they all match your goals, your risk appetite, and your tax situation, if they are quite similar and you simply can't decide, you've got to recognize that you are being Buridan's donkey. You have to simply pick any one of them at random. Realistically, the difference between these similar ETFs will be barely noticeable even after 10 or 20 years. So make sure to avoid mistake number 4, analysis paralysis. Don't become Buridan's donkey. But you also don't want to make mistake number 5, which is assuming that all ETFs are kind of the same. For example, let's say you want to invest in a broad, diversified global stock ETF. If you go to justetf.com, you will find over 60 different ETFs that fit that description. Most of these ETFs invest in very similar stocks, but some of these funds might get you substantially better long-term results. This comes down to various technical aspects that have to do with costs, taxes, and currencies. When choosing ETFs, you should consider at least these technical criteria: accumulating versus distributing funds, the replication method, the fund domicile, fund size, trading currency, currency hedging, and the total expense ratio. Getting these technical choices right could add a small but noticeable edge to your results, which can grow into a substantial difference over the decades. That's why it pays to avoid mistake number 5, ignoring technical factors when choosing ETFs. By the way, if you live in Europe and if you'd like to find out more about how to pick ETFs and choose your brokerage or handle investment taxes, I've actually put together a step-by-step training on this topic. Just follow the first link in the description to check it out.